Income Tax 2020. Income Recognition Concepts. Come in, relax with Income Tax 2020. Income Recognition Concepts. We're going to be up top in terms of our income tax equation on the income line item. Once again, remembering or thinking of our income tax equation as basically having two halves, one being a modified income statement on the top half, the other being the calculation of the tax, then application of credits and payments to get to the bottom line tax refund or tax that is due. We're focused up here on the top half on the income statement, basically revenue minus expenses, thinking about income. Two questions with income being, one, should it be included in taxable income or not? And then two, if included in taxable income, is it going to be taxed at ordinary income rates, like the rates for our progressive tax system, or is there some special rate that will be taxed at? Here, we're thinking about whether or not it should be included in income. And so we're thinking about what we'll call timing differences. When should be something be recorded in income? And typically that would be driven by two concepts, a cash method or accrual method. On the income side of things, we would be saying, okay, if it's a cash method and we received cash, then we should be recording it when the cash was received. And then if it's an accrual method, we're going to be using it when we're going to say we're going to record the income when the work was done. Now, these two differences should kind of work themselves out, but there could be a timing difference. For example, we might have the same amount of revenue that would be recorded over a 2-year time period, but a difference between these two methods as to what will be reported in year 1 and what will be reported in year 2. That difference, that timing difference, could have a substantial effect. One, because of the time value of money when we will owe the tax, and two, because there could be substantial changes to the tax law from one year to the next. So we have to know what the cutoff is in terms of when we need to be recording the revenue. Now, also note that many times we think about these two different concepts, these timing concepts, as if they're completely different extremes. One, accounting books are done on accrual method and the other are done on a cash method, and they never mix up, and that's not really the case. For example, here we're going to use the tax code, which has oftentimes some components of accrual method and some components of a cash method. So the general rule that you want to think of is a lot of times businesses, for accounting purposes, will use an accrual method. A business will typically use an accrual method, and the accrual method is usually thought to be more accurate. It's harder to distort an accrual method because it's not going to be distorted by simply changing when the cash is changing hands. But the cash method has the benefit of it being easier to track. We can have a paper trail of the cash going from one place to the other, and that can be easy for us to audit. So, and auditing is a nice thing for the government. So individual taxes will often be more on a cash basis, and then businesses will often want to run more on an accrual basis because it's often better for decision-making purposes. But again, there could be deviations in either one. We could have some areas of the tax code that are going to be on an accrual basis versus cash, and so on. So oftentimes, many sets of books aren't as extremely on either one or the other as you would think. There might have some combination. One kind of transaction might be done more on an accrual basis or tax basis for the tax code, for example. So for the tax code, obviously we're going to be following the tax code. So on a cash method, income is reported when cash is received and expenses reported when cash paid. So obviously we simply just follow the cash. Now you can see a weakness in this, however, because if I wanted to then adjust when, say, my income is going to be earned, and I want to report, let's say I want to report less income this year and maybe more income next year, deferring when I will pay the taxes. If I was on a cash method and I had control over my cash flow, I would simply just say, hey, don't pay me until next year. You know, you owe me the money, it's an IOU, pay me next year instead of this year, and you can distort when the payments will be made, and then you can kind of distort the income. So that's the problem with the cash method. The benefit of the cash method is, of course, you can track the cash, and that audit trail is a lot more easy to follow than trying to determine when the work was done. Accrual method, on the other hand, income is reported in the period earned and expenses reported when incurred, used, or consumed. So on the revenue side of things for an accrual method, you can't really distort so much the revenue that should be reported in one period or the other because it won't be dependent on the cash. You could not say, hey, I did the work for you this year, I did the bookkeeping for you or whatever, but I don't want to report the income, so don't pay me until next year. You couldn't do that on an accrual basis method because, of course, you did the work and you should be reporting the income when the work was done. But if the IRS was to audit that, it's harder to audit, because it's easier to audit basically a paper trail. So that's why large companies will typically have a full audit, like a publicly traded company will need to be on an accrual basis because it's actually more accurate. But the auditing process of them will typically be more intense. They might be needing an audit, which will look into things like when was the work done and is the revenue reported in the proper time period. On individual taxes, it's often easier for the government to say, hey, look, I'm going to follow the cash, and basically report the cash when the cash trades hands. That's going to be easier for us to report. So the default for individual taxes oftentimes will be on a cash basis. The default, especially for large businesses, will typically be on an accrual basis. They'll be required to, at some point, if they're publicly traded, for example, be on an accrual basis. So the cash versus accrual, we're looking at basically the income statement, which is basically what a tax return is. On the revenue side of things, we're saying, hey, when should revenue be recognized? Should it be recognized when the cash was received, or should it be recognized when the work was done? They may be done at the same point in time, but there could be a difference. We'll talk about that shortly. And then when should expenses be recognized? When the cash was paid, or when we actually incurred the expense, when the work was done once again. So if we think about revenue versus cash, it's a little bit different. Note that cash is not the same thing as revenue. So when I think about revenue, which is kind of like the top line of the income statement, we're talking about revenue, which is kind of like income. It's not the same thing as cash, even though we might use a cash basis in order to determine when revenue was received. So what is revenue? Revenue basically means that we have earned something. We might have gotten paid in cash. That's the most common way of paying, but they could have given us something else. Like if they said, we're not going to give you cash, we're going to give you a year's worth of free food at our restaurant or something like that. It's still compensation, even though cash wasn't received. You still got revenue, even though you didn't get cash in that kind of bartering type of situation. Or they might have just said, hey, you bill us, give us an IOU, and we'll pay you in the future. That's a normal kind of accrual type of transaction or accounts receivable type of transaction. And once again, revenue would have been earned, but cash would not yet have been received. Expenses are also not cash. So the other side of the transaction is, of course, the same, meaning I may have a situation where basically if I'm the restaurant and I paid someone else for their legal services with free food, with meals at our restaurant, then once again, we didn't pay cash, but we incurred an expense. With the expense is the cost of the meals that we are giving away in order for the services, the legal services that were provided. Or they may have done legal services and we're going to pay them later, which means we kind of have an expense when the legal services were done, but we're going to pay them later. We didn't pay them cash yet, and we would have a liability of an accounts payable. So for example, if we look at a transaction like cash versus accrual for like a pizza business that's going to be selling to an owner. So here we have owner A, which is going to be selling pizza, right? Selling pizza to owner B, which is a business buying pizza. Let's say these are both businesses here on two sides of the transaction. So owner A is going to be selling the pizza and they're going to be getting cash. Now they're getting cash at the same point in time that the pizza was delivered. And then owner B is receiving the pizza. We're going to say it's for a business meal or something like that. And they're paying then cash. So the two sides of this transaction are going to be that cash went up for this owner because they sold the pizza, they got cash, income went up. Cash and income went up. On the accrual side of things, still cash and income went up. In other words, whether we think about this from a cash basis or an accrual basis, it's the same. It's the same thing because the cash traded hands at the same point in time that the work was done, and therefore the cash and accrual method are recording at the same point in time. However, it's done so basically for different reasons, meaning on the cash basis, we're recording the increase in income because the cash was received. That's the indication that the work was done for us. On the accrual side of things, we're recording the increase in income not simply because the cash was received, but because that's when the work was done, which happened to simply be at the same point in time the cash was received, because that's the type of business we are in. So in other words, we can use a cash or accrual basis method and end up with the same transaction in this case because there is no timing difference between when the work was done and when the cash was received. On this side of things, they're going to say that the cash went down and the expenses went up because they bought the pizza, which is an expense, and they paid cash at the same point in time. If on an accrual basis, same thing. Cash went down, expenses went up. Same thing on the expense side of things. They're saying, hey, if on a cash basis, obviously cash was paid, and that's going to be what drives the expense at that point in time. The cash is the indication that expense happened. On the accrual basis, same transaction, but for different reasons. We're not recording the expense because cash went down. We're recording the expense because we incurred the actual service. We got the pizza at that point in time. It just happened to be the same point in time. There's no difference between the timing. Now, if we have a separate situation where there is a difference when the work was done and then when the cash traded hands, then we have a difference between an accrual concept and a cash concept. So for example, owner A is now a lawyer that's going to be doing legal services for owner B, but they this time want the cash up front. They're going to get a down payment, cash paid before the work was done. So they didn't invoice and get the cash later, they got the cash first. Well, under a cash basis, then the cash had been received, cash should go up, revenue would go up, even though the work wasn't done here because they got the money already. On an accrual basis, however, cash would go up and a liability would go up. They wouldn't record income. Income would not be recorded on an accrual basis because they have not yet done the work and have not yet earned the income, and therefore they owe the cash back to the owner or else they owe the legal services. So now we have a difference between the cash method of accounting and accrual method. It's simply a timing difference. Here we're going to record the income, let's say this year. Here we're not going to record the income till the work was done, which might be next year. But we're going to record the income no matter what. It's just a timing difference between the two. On this side of things, we're going to say on a cash basis, cash went down, so we will record the expense. Expense will go up, even though the work was not yet done. But on an accrual basis method, we'd say cash would go down, but we're going to have a prepaid asset go up, meaning I'm not going to record the expense yet, even though cash was paid because the work was not done. We're going to not record an expense in the current year, for example. We might record the expense in the following year when the work was done. So that's the difference between the cash and the accrual method. Let's say we do it this way. Let's say that this is the lawyer. The lawyer does work and they do the work first now. The lawyer's hired for a job. They're going to do the job, then invoice the client. So the lawyer does the work, invoices the client, and the client doesn't pay any cash yet, right? They give an IOU, meaning they're going to pay you later. Once I get the invoice and confirm the work was done, I'll pay you. Well, now we're going to say on a cash basis method, there's no transaction. We have no transaction over here because no money has traded hands yet, even though legal work was done. But on an accrual basis, you would say that accounts receivable would go up, and we would be collecting on that receivable in the future to get cash, accounts receivable being an accrual account, and then income would be going up at the point in time the work was done, even though cash was not yet received. And then on the owner side of things, or on this side of things, they're going to say that no entry would happen on the cash basis because they didn't pay cash. So they're not going to record the expense yet. But on an accrual basis, we'd say accounts payable would go up. And a payable is an accrual account, meaning we had services done for us that we have not yet paid for, so we owe the money in the future. And then we would record the expense at the point in time the work was done. So we have a timing difference once again here. So that's kind of the difference, the idea, the concepts between a cash basis and an accrual basis. So constructively received income, this is from publication 525. If you want to look it up on the IRS website, you can look up publication 525. You are generally taxed on income that is available to you, regardless of whether it is actually in your possession. A valid check that you receive or that was made available to you before the end of the tax year is considered income constructively received in that year, even if you don't cash the check or deposit it to your account until the next year. So in other words, in general, on the income statement side, on the income tax side of things, usually for individual taxes, we're kind of more on a cash basis type of method. Now, if we're thinking about like a W-2 income or 1099 income, interest income, that kind of thing, usually that will be reported to us, and we'll have it being reported to us, and it won't be that big of a question for us. But in those types of situations where we're recording the income, say a business type of situation, for example, then we'd need to determine, what method are we using and when should be recording the cash. If on a cash basis method, then things might start running in your mind saying, well, I don't want to report this income this year. I want to report it next year. What if I just hold on to this check and I don't cash it? Or what, if they gave me money, but I didn't put it in the bank account, or I just leave it in the mailbox. I don't even open the envelope until next year. Well, you've constructively received it according to the IRS, and basically you own it. You've basically received it and should be recording it as income in that way. You can't really, if it's constructively been received, you got to record it in income on basically the cash basis or the tax basis. So for example, if the Postal Service tries to deliver a check to you on the last day of the tax year, but you aren't at home to receive it, you must include the amount in your income for the tax year. So you say, well, it was in the mailbox, but I didn't, but it's basically still constructively, there's nothing stopping you from using the cash at that point in time. So they would say you'd still include it in income. If the check was mailed so that it couldn't possibly reach you until after the end of the tax year, and you otherwise couldn't get the funds before the end of the year, you include the amount in your income for next year. So if it's not my fault, basically, that I didn't have the income at that point in time, then I wouldn't have really constructively received it in theory until the following year, and then I would record it in income next year. Note, it's still just basically a timing differences. Now, prepaid income. In most cases, prepaid income, such as compensation for future services, is included in your income in year you receive it. So remember, kind of the default is a cash basis. If we're thinking the default is a cash basis, what happens in that situation where we promise to do work in the future, but we get paid today? So they're going to prepay us. They gave us the money before we did the work. That's a little bit more unusual because usually we do the work. Many kind of companies do the work before they invoice, and then they invoice and get paid later. But some businesses, and many more businesses these days, because of applications and whatnot, might be on a subscription model or something like that. They might get paid beforehand. They get the money first. So the IRS will typically say, if you get the money, we want to tax you when you get the money, even though on an accrual basis, you wouldn't be recording it as income until you earned it, until you actually did the work. So, and then it says, however, if you use an accrual method of accounting, you can defer prepaid income and receive the services to be performed before the end of the year of the next tax year. So in other words, if you have like a business and you tell the IRS, I'm not on a cash basis, I'm on an accrual basis, well, then you would apply the normal accrual concepts in that case. You would kind of be moving from the normal default of individual taxes being on a cash basis and being on an accrual basis, possibly for like a business that you have. And then you would do the normal accrual thing, which would be that you would not record the cash that you received this year if the work wasn't done till next year. You would record the income when you did the work, which would be the following year, if that was the case. So in this case, you include the payment in your income as you earn it by performing the service.